One of the most confusing things about refinancing is what happens to the escrow account, or the little account that keeps your taxes and your insurance when you refinance. People don't understand this process. So let me break it down to you very, very simply, okay? So let's say right now you have a loan that's $400,000. And let's say that that loan, simply put, the payoff is $400,000 even when you go to refinance. And your payment on that current loan now is $2,800 a month. And of that $2,800 a month that you pay, $600 of that is what's known as your escrow as part of it, right? So $2,200 for your principal and interest payment, and $600 for your taxes and your insurance, or what is known as your escrows account, gives you a $2,800 overall payment. Now, that escrow balance with your current mortgage company has $3,000 in it. Okay, roughly 5 months worth of taxes and insurance have been collected in that escrow balance. So you decide you want to refinance to get rid of your 4% rate and get a 3% rate, let's say, for an example. So you say, okay, I'm going to refinance. Well, when you refinance, you can't just simply be like, I'm going to take this and just put it right here. You just can't do that, okay? So what you have to do is this loan is going to get paid off, and as part of that getting paid off, this account gets closed. And that money that's sitting in that account can be handled two ways. One, the $3,000 that you're owed can get applied in some cases, and not all lenders do this, maybe probably about 25% of them do this, take this and they'll apply it to here and say, hey, you know what? We have $3,000 of your money for taxes and insurance. You owe us 400 grand. Just pay us off $397 and we'll call it square. We have $3 grand of your money that we're holding for you. You owe us 400 grand. Just give us $397. Now, that type of scenario doesn't happen all that often. What more than likely happens is says, hey, pay us our 400 grand, and then we're going to send you this $3,000 we owe you in the mail a couple weeks after we get our payoff. That's what happens majority of the time with majority of servicers. Now, that leads us to this point, saying, okay, well, if they can't just transfer it from here to here, well, how do I make sure that I have enough money in my new escrows account that when my taxes and insurance are due, I have some money in there? Because if I don't transfer enough over here and my taxes are due in 2 months and I don't have that $3 grand I have over here, shoot, I'm going to be short to close. I'm going to have an escrow shortage. So how does that get handled? And how it gets handled is very simple. In your new refinance, you say, okay, I got a $400,000 loan. Well, in my new loan amount, I'm going to have a $2,600 payment instead of a $2,800 payment. And my escrows don't change because taxes and insurance don't change when I refinance. They are what they are, right? So I still need to have $600 a month collected for taxes and insurance, right? Well, I got to find a way to make sure I get this $3,000 into the new account because I can't just wait to get a check for a couple weeks. So what do? Well, I collect that $3,000 over here and I add it to the loan amount. And then I also go ahead and say, hey, you know what? We're not going to make a payment the first month because they always roll typically a first month's payment into your new loan when you refinance. So I need to have the amount I had over here plus 1 month of taxes and insurance for the payment I'm going to skip. So I need to make sure I got $3,600 in my new escrows account. So I roll that into my loan amount, the $400,000 payoff plus the $3,000 plus the $600 for the new one. So my new loan amount is $403,600. So when you're comparing your loan amounts, you're thinking, whoa, why did my loan amount go up so much? Well, all we did was we pre-funded this account while you wait to get this money in the mail. Now, when you get this money in the mail, you can keep it if you want. Keep it as cash back to you in your pocket. You know, it's a nice little way to get a couple $1,000s. But don't let lenders tell you, hey, you know what? I'm going to refinance you, and as part of this really cool thing, your other lender's going to send you a bunch of money in the mail. There's a lot of slimy and grimy techniques that lenders will use to sell that. All they're doing is just giving you your money back, right? And then you're collecting it over here. So they're just moving the money around, right? We're giving you the money you had with this lender, and we're increasing your loan amount here with this lender to make sure you cover the difference. So anytime you refinance and you have an escrow account, what you have to understand is the money you have with your current lender, you can't just magically pull that money out of here and put it into that new mortgage. You can't. You either got to, one, send it back to you and increase the new loan amount to make sure we have enough into it. Or two, with some lenders, what they'll do is they'll reduce the amount that you owe them by how much money you have in that escrow balance. And therefore, when you go to pay off that loan, you pay them off less, and therefore you could have a lower loan amount. Now, this situation is based on the most common, which is you increase your new loan amount by the amount you need for that new escrow account. And when the old loan gets paid off, that lender sends you a check in the mail for the amount you have in your escrows account, and you can just keep that as extra cash out. Or if you want to pay your loan balance back down, just add that amount you get in the mail to your first month's mortgage payment, pay it in, and what do you know? You add an extra $3,000 to your $2,600 a month mortgage payment, that extra $3,000 is going to go right back down to pay that principal balance down for you. So that is the way that how escrows work when you're refinancing.